All right, good morning, everyone. Thank you for coming to the MasterClass on Global Inflationary Outlook. Very happy that you can join me to talk about what is a very, very important topic that's impacting a lot of people today. So I'm going to just focus first and foremost on the aim of what we're trying to achieve today. First and foremost, I'd like to provide an understanding for you guys on what inflation is and how that impacts the economy. And then the second thing I want to do is to talk about how monetary policy, right, can stoke and control inflation. All right, so the first part of what we're going to do today is, of course, trying to find out what inflation is and what causes it to rise and fall. And the second part, we'll talk about the sources of inflation today. Obviously, inflation today is something that is of great concern, and the inflation that we're seeing today could be quite different from some of the inflationary situations that we've seen in the past, right? Then I'm going to follow with a case analysis of the inflation situation in the United States. Now, you may ask, why the United States? Well, primarily because the United States is the largest economy in the world, and whatever inflationary pressure that it feels, right, domestically, very, very likely will spread all around the world. Okay, so we want to look at, what kind of inflation situation the United States is facing today. Then the second part, we're going to jump into a very important part of inflation, which is, monetary policy, right? What monetary policy, it sets out to do, right? Most of the time is to kind of contain inflation. Now, why containing inflation is so important, right? We would like to know about that as well. And of course, we're going to, again, right, to circle back to the United States again, because monetary policy in the United States would have significant impact, right, around the globe, right? So we want to make sure that we have a kind of understanding of what monetary policy in the US is, and then figure out how that will impact the rest of the world. Right, so that's our agenda today. Very short one. Unfortunately, it's a big area to cover, but we can only kind of just take out what are the essential parts. I guess if you have any questions in the middle, right, you can just pop it up. I'll be more than happy to address them. Okay, so let me start by just showing you, right, on a graphical way what inflation looks like today. All right, so this is a plot about how inflation looks like for countries around our region. So what do I have? I have Singapore, which is the blue line there, and I have Thailand, that dotted orange line. I have Indonesia, right, which is that red line. I have Philippines, which is that purple line. And last but not least, right, that black dotted line, that is Malaysia. Now, what you notice, of course, is that inflation has more or less been rising quite steadily, right, across these countries since about, I would say, maybe 2021, right? And of course, you look at inflation in the case of Singapore, right, compared to what has happened in the last 6 years, it's at its highest ever. The same can be said about Thailand, which is at its highest ever. All right, if you look at Philippines, for example, inflation is somewhere right in the previous high. The last time we saw high inflation in the Philippines, if you look at this chart, right, it was back in 2018. All right, then if you look at Thailand, right, that inflation number, right, has been is around 6%, very high, right, compared to what has been happening in the last 6 years. The only country, if you look at it, that really doesn't have very, very high inflation is Indonesia. That's the red line you see there, right? The Indonesia's inflation is just above 2%. Now this you can compare to about 6+% back in 2015. So the question, of course, a lot of people like to ask is, why is inflation in Indonesia so low compared to inflation in the rest of the region? Of course, unfortunately, that scope is beyond our talk today, but if we have some time, maybe we can address that in a little bit. All right, so that's the inflationary picture, right? Highest in the last 6 years, right? If you sometimes step back in history for many countries, Like for example, in the United States, which I'll show you later, it would have been the highest since the last 30 plus years, right? So the world is indeed facing very high inflation, all right? So what causes inflation? Well, very simple. Inflation is actually caused by excess demand, right? So what is excess demand? Excess demand just means that you have more demand than supply. Okay, and when you have more demand than supply, then what happens is people start to rush out to buy because there's shortages, right? Because there is not enough supply to meet demand, right? And so people beat up the price, right, of goods and services, right, to get them. All right. So excess demand can result from two things, right? One is supply shortages. You can actually have supply shortages, like for example during the pandemic, right? We realized that because of supply disruption, all of a sudden, right, we run out of food because not enough food is coming into the country, right? So that is supply shortages. Or it could also be a result of strong demand, right? So for example, when people get paid a lot, right, wages increase, right? People get more money, right? They tend to go out and spend. So the more they spend, the higher the demand, and simply supply cannot catch up, right? So if you get a situation where supply cannot catch up, although there's no disruption, supply cannot catch up with demand, you still get excess demand, right? And so excess demand results in inflation, right? So is the extent, right? Do you have massive excess demand that results in inflation accelerating, or you don't have so much excess demand, and although you have inflation, it is not so bad? Okay, so there are the way that we look at supply shortages, right? What kind of inflation does it lead to? That kind of supply shortages, we call them cost push inflation. Then you have strong demand, right? Those types of inflation that's caused by strong demand, we call them demand pull inflation. All right? So, for inflation, you can have both of them happening at the same time. In other words, you can have cost push inflation as well as demand pull inflation happening all at the same time. Right? Sometimes you may not have that. Sometimes you have a lot of demand pull inflation, not a lot of supply shortages, so you don't get inflation driven by supply shortages. You get inflation driven by strong demand. Sometimes you do get shortages, all right, and therefore you get cost push inflation, all right, pushing inflation high instead of demand pull. All right, so just make sure that you kind of try to identify the difference, right, between cost push and demand pull inflation. Of course, taking note that they could both happen at the same time, which is something like what's happening now, okay? Now, so if we kind of look at what's happening today with respect to inflation, right? Obviously, we had experienced supply disruption, right? That supply disruption has resulted in shortages. So we have experienced cost push inflation, okay? And then what happened was, when we had a lot of that closed down, supply disruption, et cetera, at the same time, there were a lot of policy supports. Governments came in, right, to ensure that people don't lose their jobs. So what happened is that protection of livelihood resulted in the fact that in that kind of stressed out situation in the economy, right, wages were literally somewhat still there. And at the same time, because nobody, or I wouldn't say nobody, very few people lose their jobs, right, they got sufficient income to continue spending. Now that kind of support has resulted in people actually going out there to spend money, right? As a result of spending money, right, we got what is called positive wealth effect happening. All right, people got money in their pocket, they go out there and spend, therefore driving strong demand. All right, now what happened, of course, is because the demand has not fallen, right, what has happened is that people also started to buy assets. What are assets? Assets are like houses, assets are like stocks. All right, so people go out there and they start to buy assets, beating up asset prices. And as people feel wealthier because their houses are now worth more, right, it adds on to the positive wealth effect. Okay? And so monetary policy, which we'll talk about later, and fiscal policy, which is all the government supports that have come in to help or save livelihood, so to speak. All right? It resulted in massive positive wealth effect that generated strong demand, right? As a result, also fueling inflation. Now, you may have been following the news, right? In recent years, right, we have had a bit of what is known as deglobalization. Now, what is deglobalization? In fact, what deglobalization really means is that the kind of globalized trade that we're seeing, people kind of stripping down the barriers, allowing, free flow of goods and services around the world, that is kind of receding. Why? Because of trade tensions, right? The Americans and the Chinese particularly is undergoing very strong trade tension, and therefore that Sino-US trade tension has also caused prices to rise. Right? Now, this is beyond shortages, this is beyond demand, right? This is politics, right? Politics can also, as a result, right, drive, right, prices. And in this particular case, because the US have been slapping on tariffs on imported Chinese goods, right? Prices in the US have also risen, and retaliation by the Chinese have also resulted in goods and services in China, prices of goods and services in China also going up. Right, so that deglobalization represented most of the time by that Sino-US trade tension, that has also resulted in prices going up outside of economics. And last but not least is that geopolitical crisis that we're facing right now in Ukraine. Right, we got a war between Ukraine and Russia, and if you think about that particular conflict, you're thinking about the impact on oil prices, you're thinking about the impact on food prices, right, as supply, right, starts to get disrupted, right, coming out from Russia, coming out from Ukraine. Of course, Russia is a major oil exporter. Ukraine itself, right, is a major food exporter. So what we're seeing because of that geopolitical tension, that food and oil prices, energy prices have also skyrocketed. Right, and of course adding on, right, to the inflationary pressures that we're seeing today. So the sources of high inflation today, right, actually comes from cost as well as demand, right, which is why you're seeing that very high inflation today that you would not have seen maybe in the past 10 years or so, because in the past 10 years when inflation happened, it usually comes from one source. It could be from strong demand. So you got demand pull inflation. You don't get that cost push inflation there, right? Or you could have a little bit of weather conditions. You could have a little bit of shipment condition that have caused, resulted in costs going up, right? So, but that usually goes away fairly quickly, and therefore you don't have the sustained cost push inflation. But this time you got both happening at the same time, right? Resulting in very, very high inflation today. Okay, so I want to talk about US, right? And if you look at this particular picture here, unleaded at $4.45 US a gallon, right? That is near kind of historical high as far as gasoline prices are concerned. So if you think about living in the United States, right, driving around, right, you will be paying a lot more. Same, right? We're facing the same problem here in Singapore and practically around the world because of rising oil prices, right? Gasoline prices have also gone up as a result, right? So inflation in the US, I'm going to share a few slides with you to just let you understand, right, what all this inflation is all about. Okay, so let me show you the first slide. All right. Now, in the United States, it so happens that they have two indexes, right, that actually measures cost push and demand pull inflation. All right. And just briefly, right, most countries would measure inflation by looking at what is known as a consumer price index. Now, what is consumer price index? Very simple, right? You go out there, right, you figure out how much consumers are paying for essentials. What are essentials? You got food, you got transportation, you got healthcare, you got education, right? You got a dwelling, right? Your rental or your house prices. You put all these things up, right? And you take a simple, a typical person's expenditure, and you figure out how those prices have changed over time. And that is what we call consumer price index, right? Consumer price index typically measure what we call demand pool inflation, right? Because you go out there, you buy stuff, right? You buy, food, right? You buy clothing, right, and all these things, and right, you consume services, right? You go and watch a movie, right? You go to for holidays, right? All these things, right, will add up into what we call consumption, right? And consumer price index basically measures that. Now, fortunately for the U.S., right, we got another measure of inflation, which is known as personal consumption expenditure. Right, the PCE. PCE index, right, in short, really measures what is called cost push inflation. That means, wages, inputs of into manufacturing, all those things, right, will most of the time be captured in that PCE inflation. So if you look at this particular slide, what have you seen? You actually see right towards the end, right, over the last 1.5 years, what have you noticed? You notice that both cost push inflation and demand pull inflation have skyrocketed. All right, and if you look at the bottom chart there, right, you notice that demand pull inflation usually runs faster than cost push inflation, right? That's expected, right? Because you go out there, you buy your food, you spend on services and whatnot, and those prices change a lot faster than increases in wages, right? You don't get your increase in wage every month, maybe you get increase in wage in 3 months or if you're lucky. Otherwise, you get your increase in wages in 1 year, 2 years, etc. So cost push inflation tends, right, to be a little bit slower than demand pull inflation. But occasionally you do see that cost outstrips demand inflation. Right, cost push inflation outstrips demand pull inflation, and those are in the red zone. Now, why is that a little bit concerning? Because when you have cost push inflation outstripping demand pull inflation, that means wages are rising very fast, right? And that positive wealth effect, remember I told you about that positive wealth effect? That positive wealth effect will drive demand a lot stronger. Right? And therefore, usually when you have cost push inflation outstripping demand pull inflation, right, creating positive wealth effect, that's when inflation becomes a key concern. And if you look at the lower line, which I'll talk a little bit later, right, the black line, that is how Federal Reserve or the central bank in the United States react, right, to that kind of inflation. Right? Whenever you see that red zone there, all right, the central bank will subsequently tighten. They will raise interest rate to try to suppress inflation. All right? We'll hold on to that. We'll talk about monetary policy in the second half. So this is how inflation looks like. Now, what has been driving this inflation? Right? Like I said, a lot of it's inflationary expectations. You go out there, all right, you think that, look, inflation is going to be 1%. It turns out to be 2%. What do? You spend even faster, right? Right? So if you underestimate inflation, you're going to generate inflationary expectations. You're going to generate rising inflationary expectation. If you overestimate inflation, then inflationary expectation will start to fall, and then you may be able to suppress inflation. So again, let me explain this chart to you. The blue line, that's actual inflation, right? The red line, right, is what the central bank think inflationary expectation is. The green line, right, is what University of Michigan go out there and they survey people. They ask them, what do you think inflation will be like 1 year from now? Right, that is represented by the green line. And what do you notice? You notice that over the last 1.5 years, consumers, right, the lower chart with the green line, has been underestimating inflation. That means they go out there, they think inflation is going to be 1%, it turns out to be 3%. They think it's going to be 3%, it turns out to be 5%. All right? And because inflation had been underestimated, it fuels, right, rising inflationary expectations. Right? And therefore inflation, right, keeps rising because consumers have been underestimating inflation. Now, what of course you notice is that for the past 30 years, if you look at the lower chart, right, for the past 30 years, from about 1990 to about 2020, for those 30 years, guys, consumers have been overestimating inflation, right? The difference between actual inflation and inflationary expectation has mostly been negative. Means consumers have been overestimating inflation. Now, when they overestimate inflation, then inflation will be relatively subdued because inflationary expectations comes down, right? So you notice, right, why inflation has been so subdued in the last 30 years is because consumers have been overestimating inflation, right? What is very, very critical right now is that if you look at this chart, right, the case for concern here is that the last time when the world had, or United States had consumers underestimating inflation in a serious way was back in the 70s and 80s. And those periods were inflation, saw inflation rising to as high as 15%. Okay, so this is inflation outlook in the United States. Bottom line, I think inflationary expectations are going to build because consumers have been underestimating inflation, and that buildup of inflationary expectation very, very likely is going to fuel inflation even higher. Okay, so how does monetary policy respond to this? Right? What is monetary policy? First, monetary policy essentially is central bank going out there, right, trying to do something in order to what we call sustain growth, right? And they realize that the best way for you to go out there to sustain growth is to try to keep inflation low. Now, why is that important? Why is keeping inflation low very, very important for you to sustain growth? Well, if you think about it, right, if prices are rising, right, let's say prices are rising, and I told you guys before, what caused prices to rise? Excess demand. And why would we have excess demand? We don't have enough supply to meet rising demand, right? That causes excess demand, all right? So what happened is that producers now say, oh, I need to meet the rising demand. I need to meet more demand. I need to produce more. So when they want to produce more, they have to hire more people, right? Right? But when they hire more people, they have to pay higher wages. So what's going to happen is that you get that higher prices, higher wages, and as wages go higher, people go out there and spend money. That drives prices even higher. And as prices go higher, workers go out there and say, look, I want to have more wage. I want my wage to increase to meet the higher wages. So you get into this very vicious cycle of higher prices, higher wages, higher prices, higher wages, up to a point where companies actually realize that, wait a minute, I can no longer pay for the higher wages to be profitable, right? And once they realize that they can no longer pay higher wages to be profitable, they start to fire workers. So fire workers, right, economy starts to slow down and the economy goes into recession. Therefore, central banks go out there and think, look, if I want to make sure that I don't get into the higher prices, higher wages vicious cycle, I need to keep prices well contained, all right? And keeping prices well contained therefore becomes the tool that allows the central bank to achieve sustainable growth, okay? Now, of course, the most difficult thing to control out there is inflationary expectations, because inflationary expectations is very hard to observe. You observe rising prices, but you don't know, right? The emotion in people, right? Do they think prices are going to go higher? Are they building up rising inflationary expectation? Therefore, right, it's very difficult for central bank to administer monetary policy correctly because it's very difficult to judge inflationary expectations. But again, that is kind of a bit outside the scope of this talk, so I'm just going to keep it tighter here. All right? Now, if you look at how monetary policy generally works, is that they go out there and say, look, what causes people to go and spend money, right? One of the things that drives spending is your ability to borrow, right? Let's say you want to buy a car, right? You go out there and say, I want to buy a car, right? You got to borrow some money to buy a car because it's a big ticket item, all right? You borrow money, and as you borrow money to buy the car, all right, you have to pay interest, right? You have to pay the interest on the amount of money you borrow, right? So the central bank says, okay, how am I going to slow down the demand, Right? If I think the economy is growing too fast, how am I going to slow it down? I try to discourage borrowing. Right? I go out there and try to discourage borrowing. I say, look, if this guy wants to buy a car, maybe he has to pay a lot more in interest. Right? If he wants to go and buy a house, maybe he has to pay a lot more in interest to buy the house. So if the central bank believes that the economy is overheating, that means inflation is rising, right, what it can do is to suppress borrowing. And how do you suppress borrowing? Raise interest rate. And it turns out that central banks, right, is the organization or is the institution that can control interest rate. Right? Again, a little bit out of scope for this talk, but right, if the central bank wants to cool down the economy, it raises interest rate to discourage borrowing. If it wants to drive the economy to grow faster, then it lowers interest rate to encourage borrowing so that it becomes cheaper for you to go out there and borrow to buy your car. It becomes cheaper for you to go out there and borrow to buy your houses, your big ticket items, right? That would generate growth. Okay, so that's how central bank monetary policy works, right? It basically tries to change interest rate, right, in order to discourage or encourage borrowing. Okay? All right. So now I'm going to talk about United States again. Circle back to the U.S., right? We know the U.S. has very high inflation, all right? And what is the central bank actions going to be? All right? So again, right? The central bank, the Federal Reserve of the United States, called the Federal Reserve is the central bank in the United States. So what does the central bank do? All right? The Federal Reserve basically works on a few targets. Right? The first thing it does is say, look, I want to keep inflation low. Now you may ask, how low is low? What do you mean by low inflation? Well, it turns out that the Federal Reserve said, okay, if I can maintain inflation at 2%, that is low. Right? That 2% target is what I'm trying to aim at. Right? I hope that I can achieve, right, inflation at 2%. If inflation rises above 2%, then the economy is overheating. If it falls below 2%, then the economy is going too slowly, right? So if it goes above 2%, the central bank will be incentivized to say, okay, right, let's raise interest rate. If it falls below 2%, right, the central bank says, oh, economy is going too slowly, let's cut interest rate to encourage spending. Okay, so that's one thing, right? The Federal Reserve makes this decision based on some kind of inflation target. The second thing that the Federal Reserve does is says, look, how do I make my decision, right? And the way that I make my decision depends on how data, right? How the economy is performing, right? The data will provide me with some idea about how the economy is performing. That is why the Federal Reserve always tells people, I am data and outcome dependent, right? So there's an issue with data and outcome dependent. Now that means the Federal Reserve will always wait, right, for something to tell how the economy is doing before it acts, right? That waiting for something to tell the Federal Reserve how the economy is doing before it acts also makes the Fed what we call a little bit behind the curve. What is behind the curve? That means they will always lag. Right? They will observe something and then they do. They will observe something and then they do. They are very seldom forward-looking. Well, for good reason, right? We don't have future history. The Fed can only think what the outcome is going to be and do something, but again, because they can only observe history and there's no future history, right? They tend to be a little bit lagging in terms of their action. The last thing that affects, right, how the Fed acts is that within the Federal Reserve, the decision makers all have their own biases. Some of them think, oh, I think inflation is really high. Some of them think, well, maybe inflation is not so high. So most of you, if you have been following the media, you would have heard the word transitory a lot. That inflation is actually transitory. Transitory, why? Because of the pandemic, because of supply chain disruption. Once the pandemic is over, supply disruption will end, right? Supply chain will go back to, a normalcy, and therefore inflation should come back down again. All right? Some within the Federal Reserve believe that is the case. Some within the Federal Reserve say, no, I think this is more structural. This problem in inflation is more deep-rooted. So they also have their own biases. And those biases influence the decision within the Fed as well. Okay, so I'm going to talk a little bit about this and show you, some of the things that people use to measure, right, decisions by the Federal Reserve. The first one is what we call the real Fed funds rate. So there are a few words there, right? Few words there. One is what is real, right? Most of the time economists say that we live in the real world, all right? And then there's Fed funds rate. So there are two things there. Fed funds rate is the interest rate set by the Federal Reserve. So that is what we call the policy rate. So the Federal Reserve goes out there, they set an interest rate, and that is the policy rate. And what is that interest rate? It's simple, it's just cash rate, overnight rate. So what is the price of cash in your pocket? That is what the Federal Reserve said. The policy rate is called the Fed funds rate. So what is real? Real turns out to be taking out price effects, right? What is called taking out price effects. So, for example, if interest rate is 4% and inflation is 2%, then the real interest rate is actually 2%. You take 4, which is what we call the nominal interest rate, or the interest rate you see, minus the inflation, which is 2%, you get real interest rate at 2%. Right? So real interest rate is nominal interest rate taking away price effect of inflation. So if you look at this chart, right, the top thing, the blue line, that is the policy rate. The red line, that's the rate of inflation. Now what do you observe in this thing? You observe that for the last 50 years, real Fed funds rate is the lowest ever. Lowest ever. In fact, it is so low that it is actually negative. Negative. You know what negative means, right? Think about yourself. You go out there, you go to the bank. You deposit money in the bank, right? And the bank gives you an interest rate. Let's say the bank gives you 2% interest rate. You say, okay, my money, I earn 2% interest rate, right? Then it turns out that, wait a minute, inflation is 5%. Now, what does it mean? If inflation is 5% and whatever interest that you get from deposit is 2%, you're actually losing 3%, right? Whatever amount of interest you receive, right, is not able to cover inflation. Right? You actually got negative impact. In this case, right, it turns out that what it means to have negative real Fed funds rate or negative policy rate is that the central bank is what we call ultra accommodative, super accommodative. So much so that if you were borrowing money, you actually receives money for that. Think about how bizarre that is, right? Right? Think about heuristically how bizarre that is, right? When you borrow money, right, the system is actually paying you, not charging you. Huh? That's what inflation. So if you take into consideration inflation, when you borrow money, guys, the system actually pays you to do so. So what will happen? Everyone will go and borrow. Because the more you borrow, the more the system pays you. The more you borrow, the more the system pays you. Right? And that's what negative real interest rate means. That's what having negative interest rate is. Right? You go out there, you borrow money, people actually pays you. Right? The system actually pays you. The system meaning the economy. Why? Because there's inflation that's higher than the cost of borrowing. So what do? You go and borrow. You go and borrow and buy your car. You go out there and borrow and buy your house. You go and buy all your big ticket items because the system rewards you, right, when you borrow. And that's what is happening in the United States, right? The borrowing costs, inverted borrowing cost is negative. And if you think about it, remember what fuels inflation? Positive wealth effect, right? Positive wealth effect fuels inflation because the inflation is so low, right? Or rather, inflation is so high that it has generated negative interest rate. People go out there and borrow, and that will fuel inflation, right? That is why, right, this time round, not only do we have supply disruption that's causing inflation to rise, we also have this problem of positive wealth effect that is causing inflation to rise. Okay? So, the Fed, remember, they're somewhat laggard, they're somewhat behind the curve. So now they may have to adjust this. Now, remember I told you about the biases within the FOMC? By the way, FOMC is Federal Open Market Committee. That is the committee that makes decisions within the Federal Reserve. Now, in economics, right, we have this thing called the hawks and the doves. Okay? The people are hawkish, right? The hawks within the Federal Reserve. They are people who are very, very concerned about inflation. They say, look, we must suppress inflation because that's the only way to sustain growth. All right? And therefore, if you look at this picture, you notice that the hawks want to raise interest rate. The doves, right, the gentle birds out there, they say, oh, I'm so concerned about growth, right? Maybe, this inflation is not so bad. We should not, suppress it so hard, right? And therefore, they want to keep interest rate low. So you have the hawks and the doves within the Federal Reserve debating, right, about what they should do. Should they be raising interest rate? Should they be lowering interest rate, right? And it turns out that today, right, because of very, very high interest rate, everyone now is a hawk. Right, so if you look at the slide for 2022, right, you got this list of people who are making key decisions, right? The Larita Master is a hawk. James Bullard is a hawk. Astor George is a hawk. We have Susan Collins who's coming in July for Boston, right? But likely will have to be a hawk too. But why was the Federal Reserve so slow to act in 2021 last year when we already saw inflation higher? When the Federal Reserve kept talking about transitory, why were they so such a staunch believer of transitory? Because if you look at 2021, you have Charles Evans, right? Here's a dove. You have Thomas Barkin. Here's a dove. You have Bostic, he's a dove. You have Mary Daly, they are all doves. So in 2021, the Federal Reserve was very dovish. In other words, they're not concerned about inflation. Remember the doves. The doves are not so concerned about inflation, right? They're more concerned about growth. They're more concerned about livelihoods. And that is why in 2021, the Federal Reserve basically did not respond to very high inflation, which in turn, of course, resulted in inflation going significantly higher this year. Okay? So, I'm going to conclude today's talk, right? Key takeaways. What have we observed? We've observed a few things, right? One, inflation is going to go higher, likely to persist. High inflation is likely to persist because most people are underestimating inflation. Because they're underestimating inflation, inflationary expectation will build. The Fed says it's data dependent, right? And therefore it will be behind the curve. It's always playing catch up. It's always playing catch up to inflation, right? And therefore, because it plays catch up to inflation, right, it will take a while before its policy is able to suppress inflation, right? Last but not least, right, we do need the Federal Reserve to come in, right, the hawks to actually come in and say, look, we're very serious about fighting inflation, and that will help to suppress inflation. Okay, so that's all I have today. Thank you very much for spending the time this morning with me. I hope you have a better understanding of inflation and how inflation affects the global economy and how central banks' actions, right, affects inflation. All right, see you guys.